Well, hello, good evening. My name is Gary Munson. I am a founder of Main Street Alternative Asset Planners, and it's my privilege to take a few minutes with you tonight, walk through what we're doing to help Americans jailbreak their IRA or 401k assets, and quite honestly, just take long-term savings dollars away from Wall Street. And just some quick housekeeping. If you have any questions, please feel free to enter those in the control panel, and I'll address any and all questions as we move forward through this tonight. But I'm pretty excited to talk to you just a little bit about what's going on. So I'm going to head right into it. Hey, many of us just feel beaten up by Wall Street. And what we want to help people understand is that the cost of losses hurt so much more than gains will help. And I wanted to use this example of, any potential, a fund or account that might start with a $100,000 balance. And the first year it loses 50%, has a really bad year. And we've had years like that. In year two, it's interesting that you have to get twice the return to get back to even. And so what I want to illustrate is that losses hurt so much more than gains help, because the losses take away your principal, and then you don't have as much money to grow as you bring this thing forward. And so, year three, we have another bad year, we lose 50%. In year four, a fantastic year brings us back to where we started. Our ending balance is right where we started. And I've talked to numbers of people who've told me, this is what my account has done since back to 2002, or someone tells me, it's been that way for 4 years. But what I wanted to show here is great average returns don't always grow your account. For instance, in this example, that fund or that stock, whatever it is, can publish a 25% return, which is fantastic. I'd love a 25% return, but I could have had money in there for the previous 4 years and not moved my account one bit. It's very frustrating and misleading. And Wall Street, frankly, you'll find out, I feel, it just isn't worth the risk anymore. Well, many people I talk to have just kind of run up the white flag as far as retiring. Their 401k has taken a real beating. The stock market has taken back, big chunks of people's principal. And they're just kind of, huddled up, trying to avoid any more damage. In fact, as we look at the stock market, it's interesting. The returns in the market, I don't think are what people think they are. And I'm going to say that, again, the risk just isn't worth the reward. This chart shows 10-year returns, each decade, starting with the first day of a decade and the last trading day of a decade. And it just shows what that 10 years looked like. The tan bars show something that stayed with or ahead of inflation. The white bars are where we didn't stay up with inflation. And let's look back just 50 years, maybe to 1960. 1.65%, 1970, 0.37%. Just not that great. Hey, in the 80s and the 90s, this was a couple of great decades, fueled by a couple of factors that were pretty unique. One was Congress created something called an IRA or a 401k. And so baby boomers, massive group, started putting all kinds of money away for their retirement. They were afraid that their companies weren't going to provide it for them. So they just started throwing money in there. And of course, when people are buying stocks, prices just go up. Another thing that happened during the 80s and the 90s is we had a tech stock boom. We have this .com thing, and the returns were what you'd expect from Wall Street. 12, 15 looks great. I just don't see those things happening again. Congress isn't going to create an IRA or 401k, and the baby boomers aren't going to start sending money in. In fact, it's going the other way. The boomers have already started to turn 59 and a half to the tune of 10,000 a day. And in fact, the front end of the baby boomers are getting ready to turn 70 and a half. And that's when the tax laws require money to start coming out of people's retirement plans. So I'm telling you, money is going to come out of the market and continue to come out of the market. And as people are selling, prices drop. I just don't see another decade, especially 2 in a row, where we're going to get 10%, 12%, anything like that. Well, look at the 2000s. We lost a half. What's it going to do in the 2010s? I think it's going to be not very good. So anyway, just so you know what you're up against, risk versus reward. So a lot of people have moved their money away from Wall Street because they've had enough, more money again coming out of the stocks and the equities, and they're trying to just keep some of their money intact. And so they've got it in a CD at the bank getting 1.5%, or they've moved the money from their 401k out of the stock mutual funds into the money market account, which is paying them 1%. and they're subject to some inflation, and there is costs of inflation, but it still seems better than losing any more. So the money is sitting there, and we need to teach people that there's a risk to inflation as well. Well, what is inflation? Inflation: too many dollars chasing around the same amount of stuff, and so the prices will just go up because people will bid and are willing to pay more. Washington continues to make commitments that needs us to just print money, print money, print money, just to keep up with the programs that have been established. And so, what does inflation mean? If inflation was really just 6% the last 30 years, and I believe it's been higher than that, but if it was and it continued in the next 6 years, I've got a girl in high school, a daughter. If she wanted to buy those crazy $200 jeans 2 years from now, they cost $225. Again, just more money to try and chase and procure the same amounts of stuff. Well, here's a way to look at it graphically. In 1971, President Nixon takes us off the gold standard, which means there's no longer a dollar of gold for every dollar running around in the economy. So they just started printing more. And you can start to see the purchasing power losses. As you look at that graph, the first big loss from about 71 to 81, it's huge. What that says: in 1981, that dollar is about 42 cents, something like that. That means that a dollar in 1981 bought 40 cents worth of stuff in 1971. Well, the red line that goes up from left to right shows the number of dollars are running around in circulation. And you can see the inverse relationship. The more dollars we print, the less purchasing power each dollar has. And you know what? It's getting worse and worse. And they tell me that inflation isn't that much, but I know that it is. In fact, the CPI is the thing that the Department of Labor uses to measure inflation, and they leave out things like energy. They leave out things like they don't let us know that they substitute, for cheaper items in this basket of goods that they use to compare prices. Well, all I know is it costs me way more to buy a gallon of gas, or to fill my car, or to go to the movies, or to buy a pack of gum than it used to. And so that's what I care about. What's my personal inflation rate? And I know that it costs more to do what I need to do. Well, here's what we want to teach people: is we want to help people know about how money grows. Albert Einstein said that the greatest miracle of the 21st century was compounding interest. And so we want to help people understand how money works, this greatest miracle of the 21st century. And let me just say this: we know that people who understand how money works, they collect interest. The people who don't understand how money works, they're paying interest. And so we feel like this is one of the greatest things that we can teach people, so they know what's going on. Well, there's a real simple rule that works just as well as a financial calculator, but it's way simpler to use, called the Rule of 72, that shows us how money grows. It simply says this: divide the interest rate of anything you're considering, maybe it's inflation at 6% or an investment that's paying 12, divide that interest rate into 72, and the answer is the number of years it takes for a sum of money to double. So let's take a look at it. Let's use 6% if inflation really was doing that. And so dividing 6 into 72, the answer is 12. So I know that if it costs me, for example, $5,000 to run my budget right now, then I know that in 12 years from now, if inflation really is just 6%, that it's going to cost me $10,000 to buy the same amount of stuff that it cost me to buy $5,000 today. And then again, if I live another 12 years beyond that, I better be prepared to pay $20,000 to buy the same amount of stuff that I get for my $5,000 today. And that is reality. Let's take a look at maybe 12%, because I know that the banks can take money in from me. Let's just shift gears into growing money now. If I lent my money to the bank on a CD and they give me 1.5%, and then they turn around and rent that money out to somebody, maybe on a business loan or for a pair of jet skis or something. Hey, we'll lend it out to you at 12%. 12 into 72 means money doubles every 6 years. So the bank's paying me nothing. They're lending it out at 12. Well, my $10,000 at year 6 suddenly doubles to 20. When they keep letting it grow, at year 12, it doubles to 40,000. Year 18, I pick up one more double at $80,000. And then at year 24, it doubles again at $160,000. And what I want to show you is we need to fight for every interest rate, every percentage that we can get safely with our money. Because if we can squeeze in one more double over the course of our period of our accumulation phase, when we're saving money, preparing to retire, If we can get one more double, all that does is double our standard of living. Let us have twice the retirement that we could have. And so we want to fight for better rates of return. A bank also can take money in from me on a CD at 1.5 and lend it back to me on a Visa card at 18%. 18 into 72, that money is going to double every 4 years, according to the rule of 72. Let's just see how that works. Same $10,000 today. At year 4, I pick up a double to 20. At year 8, another double to 40,000. At year 12, doubles to 80,000. At year 16, it doubles again, 160,000. At 20, it doubles again to 320. And at year 24, it doubles once more to $640,000. Hey, all a double means is twice the quality of life. So let's help people get better rates of return. I'm going to show you how we do that. Well, a lot of the money that we're talking to people about is retirement money. And these people are very frustrated because they've got a lot of their money tied up in their retirement account. They feel like they can't move it. They can't take it out. It's locked up. So it's in their IRA or their 401k or maybe a SEP if they're a self-employed person. And this money is just sitting there and they can't access it. And they've moved it out of the stock portfolio or out of the stock mutual funds. And again, in the money market, it's going nowhere. They feel like it's dead money. They're frustrated because they've got friends that they're using their money to do some great things. There's opportunities that they can't utilize or access, maybe a hard money loan that they could make some good returns on, or go buy a foreclosure right now, or invest in a business, or even buy a sandwich franchise. There's things that people could be doing with their retirement money, but they don't know that they can. So we're here to spread the word and tell that story. Well, does the media see this? Absolutely. Here's a Wall Street Journal article, March the 2nd of this year, talking about Mitt Romney's IRA. And his is what's called the self-directed IRA, which is what we help people with. And it's talking about his $100 million IRA. And it quotes this tax law that people don't know about. This is a big secret. Although IRAs have been allowed to hold a variety of assets since Congress first authorized them in 1974, investors have been doing conventional stocks and bonds because of that crazy market run in the 80s and the 90s. Well, we know that. But guess what? The IRA can hold anything except two asset classes. One is collectibles and the other is life insurance. So you can't buy collectible art, you can't buy collectible wine, you can't buy life insurance on yourself, but pretty much the rest of it is fair game. So we want to go out and tell people this story. And guess what? Fidelity Investments, Charles Schwab, these people don't want the public to know about it because they lose money when this money goes away. So, just a little bit more in that Wall Street Journal article. Alternative assets, the article says, makes up just 2 to 5% of $4.6 trillion held in the IRAs overall. That's a pretty small piece of a very massive pie. How much is the pie? How big is it? $4.6 trillion? Well, it's just the value of the largest 25 U.S. companies all combined. Apple all the way down to Amazon and everyone in between, including Walmart and Chevron and Procter and Gamble and Philip Morris. That is a lot of money. And guess what? A lot of people that own that money want to put it somewhere else. Let's talk about it. Investors are interested, according to Financial Planning Magazine and financialplanning.com, investors are interested in putting a portion of their IRAs towards alternative assets, but lack the know-how. And here's the key, often the advisors to do so. Well, let's find out why do they feel this way. The research found that more than 3 out of 4 American families with retirement accounts want to invest in alternative assets, but they don't know how to do it. Here's the proof. There's a survey done back in February. They asked 1,000 Americans, hey, would you like to invest your IRA dollars into something called alternative assets? Yeah, they just want an alternative. They didn't even know what alternative assets were. Well, as part of the survey, they went and asked the natural phone call these people are going to make to buy alternative assets, the financial advisors, and it asked 365 of them, hey, have you had clients that have asked about alternative assets? 83% of them said, yeah, I have. Here's the travesty, though. Only 10% of them have said they currently have clients investing in alternative assets. Hey, the financial advisor system is broken. Most of the financial advisors, look like about 90% of them, can't direct their clients into alternative assets because they can only sell the list of mutual funds that their broker dealer is signed up to sell. They don't want their advisors selling other things that they can't earn commissions and make money on. So here we've got 83% of the people that want it, only 10% of the advisors can deliver it. Wow, there is an opportunity here. This was again a survey done in February of 2012. So what do? We step in and fill the gap. We help people jailbreak their dollars, their IRA and 401k. In fact, some of their non-retirement dollars too. We break it out of the Wall Street casino because, as I already mentioned, the risk is not worth the reward any longer. We simply help people convert their account status to allow to go buy alternative assets with their retirement money. It's pretty simple if people understand it. They can do this without having any taxes or any penalties. It's just a transfer. It's just the same thing as moving it from Fidelity to Charles Schwab. It's simply a transfer. Well, what are we suggesting that people buy? We love alternative assets because they give you the control. No one cares about your money more than you. And you should be in control of what you buy and what you own. And you ought to own assets that you understand, that you can buy and sell when you know it needs to happen. You don't want to have to be worrying about what CNN has to say about what the market did today because of something strange that happened in Europe yesterday. So you need to have the control. Also, we want assets that create cash flow because that's the only way that you can retire is if you have money to spend. Way back in the day, stock portfolios paid dividends, which allowed them to hold ownership of their stock, but it sent them checks to spend. Not many stocks pay dividends anymore. Mutual funds don't pay dividends. So we need assets that pay dividends and maintain the ownership. We like stuff that is tangible goods, like real live ownership, stuff like houses and gold. These are things that won't blow away on a bad afternoon of trading. We don't like paper assets. Well, we love assets that protect against inflation. I told you, we believe that inflation is looming and it is coming in a big way. And so we want to have our clients positioned to be able to ride through the inflation and maintain their purchasing power for what they have in their portfolio so they can actually retire even in a big inflationary time. So we'll talk about that. Okay. We like assets that act like the golden goose. I've always been thrilled by that story of Jack and the Beanstalk, and they climb up there and they find that golden goose that lays a golden egg, and the next day it lays another golden egg. And they can take those things and spend it. Go, another golden egg will be there tomorrow. Well, talking about that, a guy named Robert Kiyosaki wrote a book called Rich Dad Poor Dad. He says an asset is something that creates cash flow. We totally agree. So your particular home where you live, if it's not creating cash flow, technically by his definition, it's not an asset. Well, we like to show people assets, meaning that they create cash flow, that act like that golden goose. What do they look like? We have what we call a core 4 asset classes that fit this kind of definition. One of them is residential real estate. Rental real estate, you guys, every month the tenant's paying a check of rent, comes to your mailbox. It's fantastic. Precious metals helps. This is the one asset class that doesn't create cash flow, but it does hold value, and we'll talk more about that in just a minute. Trust deeds or mortgages. You guys, the banks have pretty much pulled up stakes and left our country. They're not lending. So we've got great opportunities for our clients to step in and take the positions the banks used to take, earn great rates of return on their money, and have it be secured on a great piece of real estate. So we provide that for our clients. And then the fourth one, structured settlements. And we'll talk about what these things mean. This is cash flow, money hitting your mailbox every single month because dividends create lifestyle. This is mailbox money. This is what, again, allows you to retire. If you want to go live somewhere else, go on vacation for half of the year, have your checks forwarded to you. But we create passive income streams for our clients with things like monthly rent, mortgage payments, these structured settlement payments. It's good stuff. Well, let's talk about the first asset class that we love is real estate. Everyone loves to hear about Warren Buffett and what he has to say. On a recent CNBC interview, he said this: I'd buy up a couple 100,000 single-family homes if it were practical to do so. And he says, man, if it's held for a long period of time, these things can be even better than stocks. Well, it's not practical for him to hold that many, but it is practical for our clients to buy and hold real estate the way that we do it. We provide these homes in what we call a package form. These are single family homes, just homes, duplexes. We buy them one at a time. but we go in and we buy them at foreclosure in markets that have strong economies where the housing prices have turned around. Rents are up high and very strong. There's a broad, diverse economy with lots of job industries to help our tenants have jobs so they can pay rent in our properties. They buy these things at auction. They go in and rehab them up to good rental condition. They put a tenant in place with a long-term lease, 1 to 2 years. And then they have a property manager to take care of it. They'll take the phone calls if there's a leak or if there's a backed up toilet or something. So it becomes really a passive income for our people. Great, solid, tangible assets. Real estate is one of our great asset classes. Let me show you a couple of examples. This is a condo complex in Fort Myers, Florida. It's A+ location, and the builder started with 47 units. He ran out of money and went bankrupt with 16 left. So our supplier went in and bought this last 16. So they finish them as brand new. These are 1 bed, 1 bath, up to 3 beds and 2 baths. No problem. This is kind of what it looks like. It's a nice place. Here's a pool. There's what a brand new kitchen looks like because they just built it. Hey, nice hardwood floors. This is a nice location. The purchase price for that condo, $60,000. They've got something called non-recourse lending that is automatically approved. People don't have to qualify for this. It's just based on the property itself. And so they'll finance half of the purchase price. So our people can come in and secure this condo for $29,000, almost $30,000. Now, after paying for the taxes, the homeowners association dues, and the property management, they still net $350 a month, okay, for putting their $29,000 in real estate to secure that value. That kind of return is 14% cash on cash return. Man, that starts to sound kind of like the credit card that the bank has, but this is secure. This is real property. And man, it's just very, very solid. Here's another example of rental real estate that we love. Here's a home in Memphis, Tennessee, in a nice middle-class neighborhood. It's been rehabbed. It's in place. The purchase price was $70,000. They had financing for $33,000. So our client came in, secured it for $37,000. The interest that they're getting on the loan is 7% interest only. So after again paying the taxes, the insurance, the property managers, and the mortgage payment, we still have $6,500 coming back to us for the year on our cash in of $37,000. Call it a cash on cash return, 17.5%. That feels like the credit card that Capital One gets. Again, and we're using secured money that's held on a nice property in a middle class neighborhood in Memphis. So the second asset class that we use is trust deeds or non-recourse lending. This is having our clients step in and do the lending on these great real estate packages. Someone picks a house that they love so much that they want to pay, they're going to put half of the money down and they're looking for a loan and they'll pay 8% to get that money. And so we put our clients as the lender on the property. Again, the client's bringing in half of the money down to single family home or a duplex. And this is usually a 5-year loan. So their money is at work for 5 years at 8%. The client pays the interest every single month. And it's secured on a property like this. Again, someone loved this enough to come in and buy it. And by the way, if they've got half of their money in there, that much skin in the game, I don't think they're going to let it go through a foreclosure. So they're going to make those payments. So it's a great situation. In fact, our clients actually buy these notes at a discount. So again, it's a 5-year thing. They get interest only on the payments, but they get a discount of 5%, which means they buy a $20,000 note for only $19,000. They get the interest on the $20,000 at 8% at the end of 5 years. They get $20,000 back. So they not only got the interest, but they got the discount paid back to them. We've got a service that can collect the payments for you for a small fee, and you can play banker for a while. It's a very, very nice place to be. I feel like it's one of our safest investments. I really like it. Also, as part of our lending, is we've got some pooled funds for clients that have some money that they'd like to throw into a pool in certain industries. We can help them out with that. We've got a legal pre-settlement fund for people who are ready to settle. The companies know that they've got to pay out on a legal claim, but they just need some money to make it happen while this Settlements dragged out, so they borrow money. So we've got legal pre-settlement that pays about 14%. We've got Las Vegas Gaming Company that provides upgrades for video poker machines. That starts at 11% in the first year, ends up about 41% in the 10th year. It is fantastic. We've got another one that is real estate, where we've got people that go in and do hard money loans, short-term real estate financing at a low loan to value, meaning then we loan about half of what the properties are worth in case they have to take them back. They make a nice profit. That ranges anywhere from 4 to 10%, depending on the amount of money that you put with the company. We've got another one that helps new companies become government contractors. The government really wants women and minorities right now. So this company helps those guys get going with the government and then finances them for the 6 months until the government starts to pay. These are great places for people to get solid rates of return. And we've got that option for our clients. Okay, the last asset, or the second to last asset class, is structured settlements. Okay, what this is we've got lottery winners or people who have insurance settlements that they've gotten through the court system. And these are monthly payments that come in to these folks. A lot of people who have these monthly payments have a problem that requires a big pile of money right now. So they're willing to sell their stream of income at a discount if they can have the pile of money right now to solve their problems. So we provide the lump sum for these people. They give us, it's legally assigned, to our client, the stream of income. These yields are in the 5 to 8% range. Okay. And maybe that doesn't sound like a lot, but it is, 5 or 6 times what they're getting in their 1% CD, their 1.5% CD. So it does a really nice job. These things are paid out by some of the biggest and strongest companies in our country, massive insurance companies like New York Life or Allstate. Or maybe this is a retired military person who has a military pension that they're trying to trade in. So this stream of money is just as good as the U.S. military, the U.S. government, or one of these huge life insurance companies. So as we're looking at these kinds of investments, they're paid out annually or monthly. Sometimes it starts right now. Sometimes the payments start in the future. For the ones that start today, the rates of return are lower in the 4.5 to 5%. For those that start out in the future, that's where we get the 6 to 8% because the money has some time to grow. And as we're looking at it, we're interested in the strength of the company or the government. Most of us have a feel for how strong U.S. government is, but these life insurance rating companies go in and check the strength of these companies. Here's one, for instance, New York Life, super strong, exceptionally strong, very strong, superior. So we know they're going to be around to pay out to the end of our payments. Well, let's look at the last asset class we're going to cover today, which is precious metals. We don't tell people to go out and buy gold and silver to speculate against making a return on the prices going up. We tell people to own precious metals just as a storehouse of value. And let me tell you why. Gold and silver stay even in value against things like commodities like clothes or food or energy. And the reason is because gold, it requires an effort for someone to go out and find it and mine it and smelt it and mint it. It requires an effort. And so it's not like someone can just print more money. We can't just print more gold. We have to go out and find it. So it holds real value against things like oil. So for instance, in the graph there, the red line at the bottom that stays right there, that's the price of gold against the price of oil. The high line, the red line, is the British pound against gold. I'm sorry, against oil. The green line is the US dollar against oil. And so, the dollars certainly don't keep up. In fact, it takes way more dollars to buy a barrel of oil today than it did way back when. So gold holds value. It's not an investment. It's to hold value, and this is how the wealthy look at it. You can buy gold in increments very, very small as 1 gram, which is the size of my pinky fingernail. And so, if things really went crazy in our economy and we went into a hyperinflationary period that some people believe we're destined to hit, then you can take your small gram of gold and use it to go out and buy things like groceries or clothing. Let's look at storehouse of value continued. 1 ounce of gold over 2,000 years has always bought a fine suit of clothing. Back in ancient Rome, an ounce of gold bought a nice, beautiful tunic and brand new sandals. 100 years ago here in the U.S., same thing. An ounce of gold bought a suit, a shirt, a tie, a hat, and a great pair of shoes. Even, coming forward, 2011, I don't know where gold closed today. It's around $1,600 an ounce. But for $1,600, I can go buy a nice suit, a shirt and tie, probably a custom suit, a hat, and a brand new pair of beautiful dress shoes. Because again, it's value for value. And so the wealthy people hold a portion of their assets in gold to maintain purchasing power. Let's look at what silver does. Okay, way back in 1960, we were still putting silver in our coins. They've since stopped. And isn't it interesting that I can't even get a phone call for a quarter? In fact, I was at the airport this week and it cost 50 cents to make a pay phone call. There were 5.6 grams of silver in that quarter in 1960, and that quarter bought a gallon of gas. Now, today, the quarter, nowhere near the gallon of gas, but 5.6 grams of silver sure does buy a gallon of gas. So it holds on to value, and that's why we tell people to hold that. The silver itself, it comes in increments as small as a tenth of an ounce, which is about $5. So again, if you're worried about inflation really taking off, if you hold some wealth in silver in those small increments, you can go out and use it to buy what you need in that kind of crazy economy. Well, risk and return tolerances. We want to help our clients move their assets into additional baskets and spread them around, because we can't have all the eggs in one basket, because what if something happens in any asset class? And so we spread them around. We have a questionnaire that helps our clients decide where the money needs to go, and then they choose exactly how they want it allocated. And you've seen maybe at a 401k presentation at work where they give you a questionnaire and then they tell you to spread it. Some in a stock fund, some in an aggressive growth fund, some in a foreign accounts fund, whatever. All these are Wall Street funds. It's great to diversify, but what about getting it off the Wall Street? What about non-market assets, these things that we're talking about? And so to get true diversification, safety in many different baskets, we got to start putting some money into gold and real estate. That takes care of inflation. Gold runs up and holds value against the dollar. Real estate in a high inflationary period, if there's more dollars hitting the economy, you just raise your rents and that offsets the inflation. Of course, the value of the real estate goes up as there's more dollars in the economy. Those two things are awesome against inflation. And we're going to create monthly dividends, real estate, trust deeds, factoring, and pensions. Well, here's kind of what it looks like for an ideal account for us. We help a client go out and purchase 4 great rental homes, paying $400, $800 a month. That's $3,200 in your mailbox every single month. Maybe we help somebody secure a couple of different structured settlements. Maybe a pension from a military retirement, $500 a month, and a great New York Life pension for $500 a month through an annuity. So that's another $1,000. That's $4,200 a month in cash coming in. And then if someone bought 4 private mortgage notes or trust deeds, that's another $1,200. So you're at $5,600 and $5,400 in cash flow, and it creates kind of that pile of money in your account. And we can help our clients reallocate that cash and do like an automatic payment plan with gold or silver with one of our mints, and that can help maintain that cash that's growing and building in these accounts. And if you had an account that looked like that, you'd feel pretty solid about retiring today, because that money would cover what my budget covers. Well, again, I told you we ask our clients, some questions about their risk tolerance, and then the way they answer, it suggests the way they should allocate their funds among our different asset classes, and that's how we help people. Well, one of the tools that we use that's really vital to creating this money away from Wall Street with retirement dollars is what's called a self-directed IRA. This is the vehicle that provides investment control for our clients. It opens up those countless investment options. Again, the only thing you can't do is life insurance or collectibles. The rest of the stuff, fair game. You can go buy gold and real estate. And it gives access to the funds. And there's actually 2 types of self-directed IRAs. One is called a custodial account, and the other is called a checkbook account. And both of them have pros and cons. Well, let me talk about the custodial account. This is much like a savings account at your bank. The custodian maintains and keeps your money. The only way you get money out of there is to have them send the money, so at your request. So they charge you money to send out the checks. There's also a long line of people that also want money out, so it doesn't happen quickly. they also add investment restrictions on top of what the IRS will allow. Sometimes they may not like duplexes for rental real estate. So you get into this, mother, may I invest in this? Mother, may I invest in that? And there is real delayed access to these funds. I saw someone trying to work for 6 weeks to get money out of a custodian to buy some real estate. And you know how real estate is. It's very time sensitive. You got to have your money when you need it. So if you're buying that kind of stuff, you probably want to avoid the custodian account. Okay, the fees for that, there's transaction fees every time they cut a check. Every year they hit you with an asset value fee based on the success of your account, and then there's an annual fee to keep it open. Now those things aren't too different from what you're paying right now with your retirement money over at Schwab or Fidelity, but you just don't see it like that. But those are funds that are there. Those are fees that are there. Okay, the other kind of program that we really like is a checkbook IRA. We create what's called an IRA LLC, and this allows you to have access to your funds by just simply writing a check. The fee load is lower. All it costs is $150 for the entire year. And that's just for the custodian to report the value of your account to the IRS. You can make a deal as fast as you can write a check, which is fantastic, especially if you're doing a fast deal like a foreclosure purchase on the courthouse steps. But the most important thing too is it allows you to do any deal that the IRS allows, and we'll give you some straight and clear guidance about what you can do and what you can't do to avoid any possible pitfalls. Well, we have a partner that we are so lucky to work with. It's called Asset Exchange Strategies out of Austin, Texas. These guys are known as the industry knowledge leaders. Okay, Dan Cordova, the principal at Asset Exchange, has been quoted in the Wall Street Journal, in Business Week magazine, in Kiplinger Personal Finance, in Forbes. Dan's one of the guys they call when they need a quote about self-directed IRAs because he's an expert. Okay, they've done somewhere around 5,000 clients at this point. And it's amazing that they are still A+ with the Better Business Bureau and no complaints ever. And working with the public, that is saying something. But here's the thing that really sealed it for me about why I love Asset Exchange Strategies. They've moved over $2 billion away from Wall Street and into Main Street type of investments. They've freed that much money. And as they've gone about it, their structures, their self-directed IRAs have passed over 50 tax audits. So we know that we're sound as far as the IRS is concerned. They, of course, have won numerous industry awards. Best of Austin 4 years in a row. 5-star wealth manager 3 years in a row. Top financial advisors. These guys do it right, and they are great at what they do. Well, now it comes down to this. What's in it for you? Okay, you've been sitting on a webinar listening to this for a long time. Here it is. Can you go out and tell this story? Chances are you never heard any of this. This was new to me. That you would likely know others that need to hear it too, because man, they've given up on that money, and it is so gratifying to put people back on track for retirement and providing for them a vehicle that will make that happen, providing hope and reality. And so, do you need another income stream? Is your budget a little bit saggy? We can help with that. Well, what we do is we get information into people's hands. We provide for them this free report called The Big Ugly Secret that your IRA or 401k doesn't want you to hear. By the way, Fidelity and Schwab don't want people moving money away from Wall Street and into these these kind of assets because they don't make money on it. So we want to help people get the conversation started. As you do, and you find needs with people that you can fill, you can make great money doing the right thing for our clients. In fact, our beginning planners make about $2,500 on an average transaction. As you get better, as you get more proficient, and you can do more on your own, we'll pay you more. Our field supervisors, which is our top commission contract, those guys make $4,000 on that same kind of transaction. And so we want people to have an opportunity when they're spending time in their business to make great money for the time away from their family or their lives. And so we wanted to make sure that we got paid very well to go out and do what we do. Well, in our industry, we pay a premium for leadership because we need people to organize teams to go find people and tell the story as fast and as often as possible. And so we pay you to train and to motivate, to hire and recruit. If you want to become an agency builder, this is one of the best things you'll ever see. We pay overrides and royalties to people for making that happen and for building a team. And it is lucrative. Let me show you an example. Okay. If someone had a few planners seeing a few people, okay, you'll notice I'm going to show you a great income. It looks like $96,000 a year. You're not having to work that much. You're not having to talk to that many people. I don't expect you to recruit the entire county. So if we've got a field supervisor who's our top guy, he earns 80% of the available compensation. If he did 2 personal deals a month, I don't know what else he's doing during the month, but if he did 2 deals, that's $8,000 from his own pen. That's money that he earned himself. And then if he was motivated to go out and find 2 new planners, get them hired and trained, teach them about what we're doing, and take them out on their first few cases and help them, we'll pay those beginning planners that $2,500 I was talking to you about, which is half of that commission. The green money going up to the field supervisor, that's his pay for helping these new guys get going. So he gets paid pretty well to get out and do it, not as well as he's on his own, but he's building a business. And so he picks up another $3,000 for helping these guys each do 1 deal per month. Again, these are part-time people not doing a ton, but that brings his income up to $11,000 or 132 grand a year. Not bad. Well, let's assume that the field supervisor this is the remainder of his field supervisor's office. He's got a couple of people at 60% that earn $3,000 on their individual programs, and these 60% guys went and found 2 new people as well. So as the field supervisor helps the 60% guy, he doesn't have to do quite so much. His commission goes down just a little bit, and I'm going to assume that each of those folks do 1 per month. So the field supervisor picks up another $3,000 from each of those groups. So his income now is at $17,000 a month. We're doing 10 cases in that entire month. So again, I'm not expecting him to work 60 hours a week, and I'm not expecting him to recruit and train 1,000,000 people. Okay, this is just work. And this is just the American way. Well, eventually that 60% guy wants to become a field supervisor because he's just as good as our field supervisor and he wants the same commission. And in our industry, I've seen over and over again that we hire and train our own competition. I've seen it in mortgage lending. I've seen it in real estate. I've seen it in insurance. It's very, very frustrating. And so we didn't want that to happen. So we want our people to stay instead of going across the street and open up their own shop. We want them to stay with us. And so we give them that same field supervisor's contract as soon as they're good enough to take it, as soon as they have the experience and the knowledge. And what we've built in is a royalty income to pay the promoting field supervisor for getting that guy hired and trained and good enough to go off on his own. So he doesn't have to worry about not giving out his best phone script and teaching how to overcome objections and teaching him all the secret sauce. And so that 8% royalty goes on the gross sales of that new field supervisor's office from now on. Okay, that adds another $4,400 to that field supervisor's income. That is fantastic. Hey, maybe he does a few motivational phone calls or go in and speak at a sales meeting. We don't care, but we love that we can keep our people. And of course, as this field supervisor, the new guy, promotes somebody new, we're going to pay both of them. We're going to pay the first field supervisor a 6% royalty because this is what we call a second generation, and the first generation still gets 8%. We also pay a 4% royalty on that third generation. And we pay a 2% royalty on the fourth generation. So if there were just another 4 offices that naturally progressed and grew, that adds $11,000 of just royalty income. And that's if there's only one who creates 111. This situation builds a strong, strong royalty income. We've got opportunities here. If you want to talk more about it, I can get you a copy of the comp plan, or you can go find it on mainstreetplanners.net and go to the Join Us tab. You can download the compensation plan. You can learn more about it. It's wildly exciting. We've built it to retain and motivate our great people. Well, at this point, you got to decide how you want to be involved. Are you interested in just learning more about diversifying some of your portfolio into alternative assets? I'd suggest that you do that. Some people want to move all of it into alternative assets because they've had it with Wall Street. We'll be happy to talk to you about that and help you do the right thing for you and your family. Some people want to come in and just sell this stuff. They want to go do seminars and fill rooms up and help families over and over again. If you want to go out and be a salesperson, please do. We've got what you need here. Some people see this in a bigger light. they see an opportunity to come in and do some personal production and be an agency builder, like that income example that I showed you. We've definitely got that here for you, and we'd love to help you do that. What you need to do is, if you want to come in and go to work with us, you need to get an in-business kit, which is all of the tools that you need to get going. Okay, in the in-business kit, we've got a branded portfolio, so you look professional as you sit down with your clients. We provide this asset allocation pamphlet that helps your clients go through and understand why they want to spread their eggs into many different baskets. Okay, we also provide a $100 voucher off of the price of an IRA LLC or a 401k LLC. You can do one for yourself, and then you can use one to go out and see your first client as a reason to get out and talk to them. Hey, I've got a voucher that you need to look at. I'd like to give to you so you can see what we're doing. Okay, we've got brochures that go over each of our asset classes, that go over the IRA structure, a 401k structure, and talk about why they want to use the asset exchange strategies to set that up. Okay, we've got a great branded pin, a great branded keychain. We have the training that you need, and we've got your first 250 business cards, and I throw in a gift of The Richest Man in Babylon, which is the greatest financial planning book ever. So that's what it takes. That's what's in our in-business kit. It's all the tools you need to get going and go to talk to people. We have to charge to create the kit and get it to you. It's $139 one time. It also includes a replicated website that can be personalized to you, so you can send your clients there as they get their Big Ugly Secret report. You'll be notified of that, and you'll be able to go there and track and manage and build your client base. Okay, we have to charge $11 for FedEx Ground to bring this kit out to you. So it's $150 to get going with us, and that is it. We don't have an ongoing monthly requirement purchase-wise or anything like that. So if this sounds like something that fits for you, please, please, please get back to the person who told you about this information and shared the story with you. You need to defeat the enemy to your success. What is that enemy? And it is procrastination. What is procrastination? It's needlessly avoiding making a decision when the opportunity arises. You will never be more excited about finding out more about Main Street alternative asset planners than you are right now. Strike while the iron's hot, because you will have the law of diminishing returns. If you don't call the person back immediately, in 10 minutes, you'll be less interested. In 10 minutes later, you'll start to have doubts creep in. You guys, don't let the enemy defeat you. Defeat the enemy to your success. Get back to that person who told you about the webcast right now. Get your questions answered. And if you see yourself doing this, let's get you started telling the story. And that